Today, we are going to take a detailed look at Oracle Corporation, not in isolation, but within the current macroeconomic environment. Over the last few months, we have seen a significant shift in U.S. economic data. Inflation is cooling faster than expected, the labor market is softening, and central banks are increasingly signaling a move toward easier monetary policy. At the same time, Oracle stock has fallen more than 45% from its recent all-time high, which it reached around the 10th of September. In this video, I will explain what the macro data is telling us, how that environment historically affects technology and growth stocks, and why Oracle at current levels may represent a compelling risk-reward setup. This is not investment advice. I am simply sharing what I can see based on data, charts, and fundamentals. Let us start with what truly matters for U.S. equities right now. U.S. inflation has surprised meaningfully to the downside. Core inflation year-on-year is around 2.6%, while headline inflation is approximately 2.7%. Both readings came in well below expectations near the 3 to 3.1% range. This matters because core inflation is the Federal Reserve's preferred measure. At these levels, inflation is now close to the Fed's long-term comfort zone. In my opinion, this significantly reduces the probability of further rate hikes and strengthens the case for rate cuts next year. The labor market is also clearly cooling. Payroll growth has slowed and the unemployment rate has risen to around 4.6%. However, this is not a collapse. It is a controlled slowdown. Historically, this type of environment has been supportive for equities, particularly rate-sensitive growth stocks. Taken together, cooling inflation and a softening labor market are exactly the conditions where markets begin to price future monetary easing. This matters especially for technology stocks. Technology companies, particularly large-cap software and cloud businesses, are highly sensitive to interest rates. Lower inflation leads to lower bond yields and lower discount rates applied to future earnings. As a result, the present value of long-duration cash flows increases. That is why technology stocks often outperform before the first rate cut, not after it. In my opinion, the current macro setup is structurally supportive for high-quality technology companies with strong cash generation and recurring revenues. Oracle fits squarely into that category. Oracle is often misunderstood. Many investors still view it as a legacy database company, but today, Oracle operates across enterprise software, cloud infrastructure, cloud applications, government contracts, and AI-driven enterprise workloads. Oracle's cloud infrastructure business has been growing much faster than the overall company, while margins remain solid. Importantly, Oracle generates strong and consistent free cash flow. It has long-term enterprise relationships and extremely high switching costs for customers. This is not a speculative technology stock. It is a mission-critical enterprise platform that produces real cash flows. Now, let us look at the price action. Oracle reached an all-time high in early September and then declined by more than 45% from those levels. From a technical perspective, the stock has retraced a large portion of its prior advance. Both the weekly and daily charts show signs of stabilization, and momentum indicators are no longer stretched to the downside. In my opinion, this type of drawdown without a fundamental collapse often reflects valuation compression rather than deterioration in the business itself. Historically, buying high-quality technology companies after 40 to 50% drawdowns during periods of falling inflation has offered favorable long-term outcomes. That said, risks still exist. A sharper than expected economic slowdown could impact enterprise spending. A renewed spike in bond yields could also pressure valuations. If unemployment were to rise aggressively above roughly 4.8 to 5%, broader market sentiment could weaken. However, based on current data, the macro environment still aligns with a soft landing to early easing scenario. This is clearly my personal opinion, not a recommendation. Based on cooling inflation, a softening but still stable labor market, a central bank pivot narrative, Oracle's business quality, and a more than 45% pullback from highs, I personally view Oracle as potentially offering a deep opportunity within a growth framework. For transparency, I have already taken some positions at lower levels and may consider adding further if price action continues to stabilize. Again, this is not advice. It is simply an explanation of how I am interpreting the data and the charts. If you would like a technical level breakdown, a valuation comparison versus peers, or a short-term versus long-term scenario map, let me know in the comments. Thank you for watching.